All right, I just wanted to make a quick video explaining and demonstrating how to sell a credit spread in the ThinkorTrade platform. Credit spreads are very powerful tools. Instead of just outright buying the option contracts and then suffering from theta decay, which is the time decay, selling the contracts to somebody else puts the theta decay in your favor. Um, so if whoops, wrong thing. If we're not familiar, theta decay. So this is the curve, the theta curve. Um, what we're trying to do is we're trying to take advantage because options are depreciating assets, right? If they expire out of the money, they will be worth zero. Um, so if we sell this depreciating asset to somebody else, we can put that in our favor, and we can basically take their money, take in the premium. It's almost like an insurance contract, taking the premium, and as long as they don't um, make a claim, we get to keep that money, right? In this case, as long as the option expires worthless or out of the money, we will keep all the premium. So the common wisdom is you want to sell generally between 30 and 45 days or so into the future. As you can see, or the reasoning behind that is that's when the decay, the time decay really starts to take effect. If you sell like 3 or 4 months into the future, it'll take a long time for the premium to decay. So what we can do is let's just say let's just choose Microsoft here. Go to our trade tab. We're already on the option chain here. You can see all the different expiration prices, and of course the strike prices. I'll choose November. It's currently December 20, or excuse me, October 26th. So, and let's just think. Let's assume that we think Microsoft is going to go up. You still have to pick a direction with these trades. But another big advantage though is to get to win 100% of the premium as long as the trade, as long as the stock closes 1 penny or higher above the strike price that you choose, you'll keep 100% of the premium. So with conventional stock, if you want to make 10%, well, that stock has to go up 10%. In this case, it's almost like the tail wagging the dog in a way. So what we can do, let's just say we're going to sell at the money. Obviously, down here you have in the money, or you can do out of the money. If you try and do, well, anyway, let's just do at the money. So you right click, you hit sell, or open the sell menu, choose vertical. These trades are sometimes called vertical trades because you can see so what we're doing here is we're selling 10 contracts of Microsoft that expire November 17th, 2023, and the strike price is going to be $330. So those are the so you can see the negative sign here. These are the ones that we're sell over here. We're selling 10 of these contracts. Now at the same time, we're going to buy 10 of these contracts, the 327.5, and you can change these, which will give you a different risk reward profile, which I can show you. And so the idea here is that we're selling these. Well, I'll say so. So the program will do the math for us, which is nice. It'll show us our max profit, which is $1,100 potentially, and our max loss is $1,400 potentially. So in this case, if Microsoft closes 1 penny above 330, we will keep that $1,100. However, if it's below, we will lose 1,400. Now that was the risk reward. Like I said, you can change that by obviously changing the amount of contracts you choose to sell. So if we only did 5, the numbers would change to 550 max profit and 700 max loss. Or you can also change the spread between the strike prices. So instead of the 327, we're going to now make it $5 and use the 325. You can see now we're getting 212, 215 per spread or per contract that we sell. So now we can make 2100 or potentially lose 2900. It all just depends on your personal risk tolerance, your account size, et cetera, et cetera. And then obviously you have the standards, limit order. You generally want to use limit orders, market orders, especially depending on what stock you're using. Microsoft is going to have good liquidity, but if you're using a smaller company or maybe a obscure ETF or something, the spreads might be pretty wide on the contracts. So it's better. It's just almost better to use limit orders. So I'm not going to execute the trade, but I will. I do want to analyze it. I'm going to show you how it's displayed in graphical form. So basically, over time, you can see the date down here. Currently, this is today. As we go into the future, this purple curve is going to end up matching the blue curve. And as it gets so here down below, this is our stop price, 330, right? That's our short strike. That's the strike that we chose. So on November 13th, if the market was if Microsoft was trading at 332, we will have made 500. Assuming all other conditions are the same. Implied volatility, all that stuff, which, they change. So these numbers are just sort of theoretical, but they're usually pretty close. So yeah, if Microsoft's trading at 334, we will have made $807 in profit on November 13th. And as you can see, as we get closer and closer to the expiration date, those numbers will get bigger. So again, at 334, we will have now made 1,600, a little over. The max we can make again on this trade with the $5 width and 10 contracts would be about 2,100. So if on November 17th, let's just say Microsoft had really good news and it skyrocketed up to $343 per share, we will have already basically made the max profit. And at this point, you can just close the trade early. You don't have to wait until the expiration date. Which usually this is what I mean when I say it's still a directional trade. Because ideally, you still want Microsoft to go up, but it doesn't have to though, which is the nice thing, right? So they expire the 17th, and then by the next day, we will have made our max profit up there, 2,100, and then you can see down here max loss is 2,900, or over here on the left-hand side of the screen. Yeah, so that's basically the gist of it. They're very powerful. When you can also, another thing too is you can change your risk reward as well. If you go further into the money, you can see. So I chose the 330 last time. Let's do 340. So in this case, we think we'd be really bullish on Microsoft. We think they have good prospects. And for whatever reason, we think they're going to go up to 340 before the 17th. So in this case, let's change this back to the $5 spread. In this case, now we're getting $307 per contract. So if we look at the details here, we're now getting even more. Our potential max gain is 3,100, and the max loss is 1,900. And this is because we're now so much further in the money. So anyway, notice I've been selling puts, right? If you think Microsoft's going to go down, it would just be the opposite. You would want to sell call contracts, right? So it's the same deal. You just choose, where you think the price is going to go. Let's say we think it's going to fall to 325. So we'd right click, sell, vertical, and just get the same information here. We can make 1,500 and we could lose 1,000. So it's the same deal. Um, yeah, and you can also, I forgot to mention, you can also benefit from the implied volatility from the IV going down as well. So let's say, over the course of these 3 weeks, or, yeah, until the 17th, let's just say Microsoft, there's some, I don't know, say like I don't know, a lawsuit was resolved, right? And it was resolved in Microsoft's favor. That would be removing a lot of the risk from the company. Let's just say it was a big lawsuit. Um, and that would likely mean that implied volatility would come down, which is just another component of the price of an option contract. So as that would come down, that would mean because remember we sold the contracts when they had the higher implied volatility, um, that would be working in our favor. Uh, a lot of people implied volatility will generally go way up, right? Like right before earnings announcements, for example. So you can make earnings plays instead of buying. Let's just say you think Microsoft's going to have good earnings. You could buy the 335 contract, but the implied volatility might be really high, to the point where even if the shares did go up to 335 or 340, whatever, you still might not make a bunch of money because you paid so much extra premium in the form of implied volatility. So you can get around that though. You can put they call IV crush. You can put that in your favor, again, by selling the contracts, right? Instead of buying, we're selling. Um, well, we're selling and technically we're selling and buying. And the spread is where we make the money. So anyway, I think that about covers it. Um, I would, if something doesn't make sense, leave a question. I'll try and answer it. Obviously, you can just Google credit spreads. There's tons of other information and probably much better videos out there. Um, so yeah, good luck trading. It's a tough market. Oh, one more thing too. This strategy doesn't work very well in terms of high volatility. Um, so let's wait. Hold on. Let's just quickly look at the SPX. The S&P it's been really choppy in the recent months. Coming down, big sell off, back up, big sell off. Um, it's it's hard. It works much better during a trending market, right? Either up or down, doesn't matter. If we're trending down, you can sell calls. I mean, currently it looks like we might be starting a big new downtrend. So say it pops back up to the 21-day moving average. Maybe it'd be a good idea to sell calls in the S&P. But anyway, the point being though, this strategy is much easier to utilize during a trending market. Um, so just keep that in mind. All right. Good luck and happy trading.